Hi guys, good morning and welcome to Trading Hour. I'm Pavitra Parekh. With me is Mangalam Malu. And Mangalam, this is looking like a good start, good day of trade for our own markets. We did get that very positive handover over from Wall Street. All of the Asian markets are also well in the green. And for our own markets, after getting that gap up, we've only sustained at those higher levels, right? So we did open above that resistance zone and we have sustained at those higher levels. So that is a good point to track. In terms of what's doing well today, a lot of the gains are led by the IT pack as well as the autos. So a few of those names will be up on your screen. So that's what is looking really good. On the downside, you do have some of the metal names which are seeing some cuts, as well as some of the PSU banks which are taking a bit of a breather today. Of course, this week, the big Q will be the US Fed meet that we're all tracking very closely. But Mangalam, we've opened at higher levels, we're sustaining, so that's definitely good for our own markets.
That is good for our own markets, but where we are right now, is an extremely crucial zone, 17,950, because that's the level from where a lot of the call writing, may unwind if this level sustains. We're doing well for the first hour and a half of trade. Let's see whether that sustains or not. The second half will be a lot more crucial. Chances are maybe that, the street says that, okay, we've got these gains, let's consolidate at these levels before we get any commentary coming in from the Fed in the next couple of days as well. So we'll keep an eye out on that. And the strength of the market, of course, will be in the way the IT stocks, the Nifty Bank, as well as the mid-caps move, because the Nifty Bank is a mild underperformer in today's trading session. But we do have a lot lined up on the show, right?
Well, so let's go through everything that we have planned over the next 1 hour. The market is near the day's high after a strong open. It is autos and IT which lead the charge, while metals and energy lag. We'll discuss the way forward for the market with Siddharth Khemka of Motilal Oswal Financial Services.
From the earnings corner, we'll be joined by the management of CCL Products and Transport Corp to discuss their quarterly numbers and the outlook, importantly, going ahead.
Bandhan Bank tanks after a dismal set of Q2 earnings. Brokerages also cut their target on the stock. We will get you all of the highlights in just a bit. In big earnings to track for the day, L&T as well as Tata Steel will post earnings today. We'll get you the expectations in just a bit. So all of this and lots more coming up for you over the next 60 minutes.
All right, let's talk about Bandhan Bank. In fact, that's the one that is tanking in today's trading session. In fact, it ended at the low point on Friday as well. Thereafter, we got some more details and the management commentary, some brokerage downgrades as well. The stock currently sitting with a cut of almost 9%, closing in towards that temporary freeze of 10% mark as well. What has spooked the street so much? Abhishek joins in to tell us more of that. Abhishek.
Well, Mangalam, as you mentioned, brokerages have written on Bandhan Bank, and they say that Bandhan Bank has arguably, underestimated the EEB stress pool and is taking longer to shrink it. So the expectation is that now EEB stress pool will get mostly written down in FY23. Provisions have remained elevated this time around and is expected to remain elevated in H2 FY23 as well. So the earnings will normalize in FY24. They remain watchful of the high SMA or special mention account book and asset quality of the bank. So credit cost guidance also from the bank has been raised to about 3% in FY23 versus the earlier guidance of 2.5%. So brokerages across have cut the net interest margin anywhere between 80 to 100 basis points, and they have also cut the earning estimate for the bank. So for FY23, the brokerages have cut the earning estimate anywhere between as low as 13% to as high as 50%, and for FY24 they have cut the estimate anywhere between 7% to 30%. So across brokerages you are seeing a decline or cut in target price, while they maintain their bullish view on account of the valuations that Bandhan Bank trades in. So the target price has been cut as low as 6% to anywhere as high as 18% by all the brokerages. Back to you.
All right, Abhishek, take that point. Thanks a lot for joining in and giving us the lowdown on Bandhan Bank. But let's now invite the first corporate on our show, Trading Hour, CCL Products. That reported a largely inline set of numbers in the second quarter. The stock holding up mildly in the green as well. There was a growth year on year, but sequentially, there was some sort of pressure. So to discuss the quarter gone by, the status of the capacity ramp up and more, we are joined by the company's Managing Director, Chala Srisan. Chala, thank you for joining in. Always a pleasure speaking with you. The first couple of questions. In the quarter that went by, what was the volume growth that you posted? And at the same time, what was the EBITDA per kg?
The volume growth was approximately around 22%. The EBITDA per kg is more or less the same as it was earlier. There was a slight reduction in India because we have outsourced a lot of our production because of capacity constraints.
What was that number on an absolute basis? Can you give us a sense?
About 108 rupees approximately.
Okay, good morning, Chala, and thanks for joining us. This is Pavitra. On your revenue, last time we spoke to you, you said that you can do around 20 to 25%. Looking at the current run rate, it looks like you'll be able to do a lot more. Would you be revising your guidance, or do you still think that for the full year we should expect around 20 to 25?
So actually the guidance that we are given is that the top line growth, the revenue growth will be closer to 50%. But that is actually because of the raw material prices. It's really not because of volume increase. The volume guidance that we are given is 20 to 25%. So the guidance remains the same. Our top line guidance is also closer to 50%, and that guidance also remains the same.
Right. And what is your, utilization of the small packs? Because that is a higher margin product for you, right? Where does that go from now to, say, the next couple of years?
So as of now, we are at around 60% utilization. We are looking at almost 80 to 90% utilization by next year. And we'll be adding a couple of equipments to enhance the capacity as well. The factory that we have built for small packs, we have actually built the infrastructure to more than double the capacity by just adding equipment with minimum investment. So that once we reach this 85-90% utilization, we'll be adding the capacities as well.
So what does that do to your EBITDA per kg? I mean, from 108, where does that go? Because that is margin accretive.
Yes, so we are still guiding it's going to remain at more or less 108 because our volumes are actually going to increase more in spray-dried product. So in our product mix, freeze-dried and small packs will give you definitely better margins. But the expansion that we are doing is more in spray-dried. So even though if we increase our margins in these other two products, by sheer volume growth, if we maintain the same level itself, is a good sign for us.
Okay, got that. And speaking of margins, can you tell us what we can expect? Because I do know that sequentially there has been an improvement, but if I look at it on a year-over-year basis, there is still quite a significant, contraction on that front. So what do you expect margins to look like for all of this year?
So we've actually given a guidance of an EBITDA growth of approximately in the range of 20%. And as of now, we are completely on track for that. In fact, if you look at the first half year, we're at about 20.68%. So, and bottom line also is at around 18.6% is our growth in the first half. And in the second half, it will actually be slightly better than this.
Right. Second half margins will be better. Chala, we ask this to you every quarter, and that's because of the massive capex plan that you're on. What does your capacity currently stand at? What does it be at the end of this year? Where do your capacity utilizations stand at?
So right now, we are actually at 100% utilization, and our capacity is around 38,500 tons. We are outsourcing a lot of our production because we are trying to build the market before our new capacities come online. One of the reasons for the EBITDA percentage reduction is also because of that. Once the capacities come online, that reduction also will go away. And the new capacity that's coming online, an additional 16,000 tons will come online by the end of this calendar year. And hopefully in quarter 4, we'll end up doing the trials and we'll start seeing additional volumes coming in from quarter 4 itself.
Could you tell us what kind of volume you would expect with all of these new capacities on stream?
Initially, we are looking at for next financial year with the new capacity coming online, we are looking at a minimum of 50 to 60% utilization of the new capacity. So on an overall blended basis, we are looking at maybe a 75% utilization of our overall capacity for next year.
That's roughly 70 to 75,000 tons in terms of volumes.
75,000 tons will come by the end of next financial year.
Right. Also on the India business, Continental Coffee, I mean, what have you done in the second quarter? What's your target for the entire year and going forward?
The branded business, so there are two parts to the Continental business. We have a branded business as well as a private label business. So the branded business is what we are targeting approximately around 180 crores for this year, and we are on track for that.
Okay. Also on the global exposure, we know that I think the last time we spoke, you said you have around 20% exposure to Europe. Can you tell us, have you seen any kind of impact there because of the inflationary pressures? Is there any hit to that business?
Actually, yes, we have seen an impact because what's happening in Europe today is there's a huge energy crisis over there. So all the manufacturers, the European manufacturers, are not able to produce over there, and they're ending up depending on imports a lot more. So we've started seeing a lot of order confirmations coming in for all of next year as well. So volumes in Europe will actually increase a little disproportionately for next year because of all this.
Okay. Just one final question on the plant-based products that you have on the plant-based meat. Can you tell us what is the revenue contribution from that segment right now and where do you expect it to head?
It's actually very small right now. We're looking at about maybe around 40 lakhs or so. And we're looking at investing around 10 crores behind this brand over the span of next 4 to 5 years.
Okay, take that point. It'll be interesting to see where this goes because this has been a valuation driver for a lot of companies who are in this space. But for you, we'll obviously look forward to your capacity increasing and the contribution of revenue coming in from the domestic business itself. Thanks a lot, Chala, for joining in. Always a pleasure speaking with you. With that, we'll take a short break. On the other side, we'll discuss the commodity space. Manisha Gupta. Welcome back. Let's shift focus to the commodity space as the equity space continues to stay abuzz and hold on to the gains. And today we are focusing on wheat. Manisha, wheat's going to be expensive.
It is. It already is. Actually, overnight, we've seen 6% of gains come in for the global wheat prices there, and the Indian prices are getting impacted as well. The global markets first, and this is because Russia has withdrawn from the Black Sea export agreement. We do understand that nearly 9.5 million tons of grains, which is inclusive of wheat, corn, sunflower, barley, mustard, soy, etc., has been exported via Black Sea since the month of July. After the statements from Russia, there are statements from UN, Turkey saying that they will go ahead with the grain export deal, but with Russia withdrawing, the uncertainties are just about gaining here. Also, when you do remember, the wheat price has hit an all-time highs in the global markets at around $13.6 per bushel in the month of March. Since then, we've seen the wheat prices come off by 25%. But as I said, the last overnight trade has been nearly 6% on the higher side into the markets there. For the Indian markets as well, we have seen lower crop this time around. And because of the higher prices, there has been more crop that is lying with the private trade rather than in the government buffer stock. And in the open markets, there is just about 1 to 2 months of stock that the roller flour mills have as of now. So the wheat prices, which have gained by nearly 15% in last 6 months itself, in the Indian markets, the expectation are that for the next 2 or 3 months, there could be higher wheat prices here. You remember also that India has banned wheat export after we saw international markets jump up as well, and the Indians' availability was also declining. The expectation is that with what has happened at Black Sea, you could be looking at higher wheat prices, not just in the global markets, but the Indian space as well.
All right, Manisha, thanks a lot for getting us that quick update on wheat prices. But with that, let's move on and talk about Maruti Suzuki. It is one of the top gainers on the Nifty today, up around 2%. This after a strong set of Q2 earnings as well as strong management commentary. Brokerages have also gone ahead and raised their target prices on the stock. Now, let's actually get you a conversation that my colleague Parikshit had with R.C. Bhargava, who's chairman of Maruti Suzuki, on where they see growth heading from here. So let's listen into that chat.
It's not fully behind us yet. There's still problems in some of the vehicles, and we expect this problem to continue for at least another 2 months. So we have really not been able to produce as much as we needed to produce, as much as the demand was there. That's why the back orders have gone up, and there is scope for improvement.
Right. Also to ask you about the growth of the automotive industry. You expect the automotive industry to grow at 8% in the next fiscal. You said that we're looking at record volumes for the auto industry. Will Maruti Suzuki's growth be in line with industry?
We will attempt to do that, yes.
But we also see some pressure, some continued pressure when it comes to the entry-level segment. Will that be a challenge when it comes to meeting the industry growth rate?
We have taken that into account when we have made our projections for the next year.
Mr. Bhargav, now coming to volumes of entry-level cars, give us a sense as to, on a quarter basis, how have they been impacted, and how do sales for the entry-level cars, the bread and butter segment for Maruti, look like?
The entry-level segment in this quarter too has shown a growth. It's the first time it's shown a growth after many quarters. But I think this is the result of the festival season and the fact that whatever people could manage, they came out and bought now. We do not expect that this quarter two growth in the segment will continue as we go ahead this year.
So,
over the last 3 years, this segment has declined by something close to 30% now.
So I'll just take that again. You're saying that you do not expect the festive season growth for the entry-level segment to continue?
That's right.
Right. Also, to what extent are you going to repurpose or redefine your strategy going ahead? Maruti has launched the new Brezza. You've got the Vitara. You've got at least 2 more SUVs which are going to come out to be rolled out in the next few months. How soon or how fast will Maruti Suzuki be able to redefine its product strategy?
But this is what we are doing. They're putting all these new SUVs and things is really what we're trying to do to redefine our strategy. Our composition of vehicles is changing. Instead of having 70-75% vehicles in the hatches, this percentage is going to drop as we go along. As more production takes place of all these vehicles that we just talked about, the percentage of these cars will increase and the hatchbacks and the entry-level vehicles will drop.
In your estimate, by 2025, what will be the estimate of small cars in Maruti Suzuki's product portfolio?
I haven't made an estimate till 2025. We don't know what the conditions will be till then.
Right. You've spoken about the Auto Expo, Mr. Bhargav.
Yeah.
If we were to request you for some sort of numbers, some sort of sense as to the SUV roadmap for the remaining part of this fiscal and the next 2 years, how many product offerings could come from Maruti Suzuki when it comes to the SUV segment?
I don't think we ever give any specific indication of the numbers of products or the types of products. All I can say is that we will continue to make whatever entries they are required to be made in this segment to make sure that we can fully utilize our production capacity, meet the customer's needs, sell what we can produce. Because there's no point having production capacity of vehicles which we cannot sell because the customer has gone away from that segment.
All right, that is the conversation that we've heard from the management of Maruti. The stock hit a fresh 52-week high on Friday's trading session post numbers, continues to hold on to those gains and currently closes in towards that 9,700 rupee mark on that share, sitting with a gain of 2%. We take a short break, come back on the other side. We'll be joined by the management of...
Welcome back. You're still tuned into Trading Hour. The market is inching even higher right now. So it's a 190-point gain that we have on the Nifty. We are at the day's high currently, but a little bit of underperformance is coming through from the bank. So do keep your eye out on that. Even that said, it is a gain of around 0.6%. So all in all, we do have a good looking screen. But let's talk about some key earnings which came through. Transport Corporation of of India is in focus after reporting its second quarter earnings. We did see a steep fall in the Seaways margin, which is weighed on the operational performance. We'll talk more about that as well as the outlook going forward. And for that, we have Vineet Agarwal, Managing Director of the company, joining us now. Vineet, good morning and thanks for joining us. This is Pavitra. I'll get to the individual segments in just a bit, but first, if you could sort of take us through the overall performance and really break it up into how much has come through on the volumes and on price hikes.
Hi, Pavitra. Always good to be here. This was our record quarter so far in terms of the revenue growth in total. And this is on the basis of the fact that there is a lot of pent-up demand that exists, and almost all our divisions did well, barring, of course, the Seaways business, which has been going through the current fall in freight rates have impacted it a little bit. But more importantly, the division went through almost 3 of its ships went for dry docks over the quarter. And that led to less operational availability of the ships in this quarter, and hence it was lower margins. But overall, the business remains extremely robust. We are seeing huge demand coming in, for example, for the automotive sector. We saw the festival season again keep up the demand overall. So overall, it was a good quarter for us, barring a little bit of a blip on the Seaways side.
Take that point, because if we just take a look at the other segments as well, freight has grown 14%. We've seen a 26% growth come by in the supply chain business as well. But we need just a couple of questions with regards to your overall outlook. I mean, the first half you've done 21%. You had guided for around 15 to 20% in terms of revenue growth for this year. You expected margins to sustain. What is your outlook for the revenues for this year? And Seaways, when do these dry dock ships come back to operations, and where do margins stabilize there?
Yeah, so essentially the 10 to 15% growth on the top line and the bottom line in terms of guidance stands, because Q3 and Q4 was quite robust for us last year. And I think some of that momentum from now will continue, but perhaps a little bit slowdown in the fourth quarter might be there. But barring that, 10-15% on the top line, bottom line is expected. On the Seaways side, the ships are already there. They came in the first week of October. So the next 6 months, that is the Q3 and Q4, we will see full results from them. We have to note that the international freight market has come down quite a lot, about 30+%. And that has had some impact on the local market as well. We did some trips to overseas markets and capitalize on that when the rates were high. But clearly, good times on those sectors do not last forever. So we have come to a normalized state of margins right now. And I think going forward, the overall 10 to 15% will stand.
So what is the normalized state of margins for the Seaways business? I mean, we've seen it at 35% same time last year, which you said was obviously a blip. Now they've come down to 25%, but that's primarily on account of 3 of your ships not being in operations. Now those numbers are here. I mean, are we looking at 27, 28%, 30, 32%? What is a normalized level?
So the typical margin that business is at about 30-odd% EBITDA. And that's where it would possibly be. You're talking about EBIT margin, talking about EBITDA margins. So EBITDA for us would be about 35% odd. And we will come back to that in these 2 quarters.
All right, got that. So that is on the Seaways business. Could you take us through how the festive season is looking for you? Because, the last time we spoke, you did say that festive season stocking has begun, but there was also some disruption that you were facing because of the auto sector. So can you tell us how things stand now?
Yes, the auto sector has come back with a bang. I think there is a lot of pent-up demand that is going through across the country, and we've acquired new contracts in both our in the supply chain side of the business. And this is not just on the road side, but also on the rail logistics side. As you know, we also own 3 trains for AFTO, which is the automobile freight transport. And we are doing that quite robustly. We have yards that we've set up for automotive transportation. So what happens is that a bulk movement takes place by rail, which helps companies to save costs as well as helps them to reach their ESG goals. And then we do a distribution through a spoke method. So it's a hub and spoke method for auto distribution. And we are seeing a huge amount of traction here. Not just four-wheeler, three-wheelers, but also two-wheelers to some extent has picked up, but tractors have picked up also to some extent.
Tractors have picked up. We've seen that in the commentary that have come in from M&M Escorts as well. And more importantly, the stock price of M&M also this year has rallied almost, what, 60, 62 odd % there. But the cold chain business, that was your, new baby, so to say, which you entered just about a year ago. How has that scaled up? What are the long-term plans for that business?
The business has grown by about, in the half yearly, I think about by 20% odd. And we are in line with our targets. We have acquired some more contracts for some QSR companies and also some retailers. We also do some work on the dark stores for some of the new startups, but their business model keeps changing. So that has an impact, and we don't have a predictable cycle sometimes with them. But it's very exciting right now with all the consumer trends that are changing. Visibility in terms of pharmaceuticals now moving a lot more towards cold chain or even specialty chemicals. So it's very exciting for the next few years for the cold chain business.
Now, and what rate is it expected to grow at?
We expect the business to grow at about roughly about 30% this year.
How much does it contribute right now?
I'm sorry?
How much does this contribute to your revenue right now?
It's very small right now. It's a very small business right now. I think last year we did about 60 crores. Okay. This year we should do about 80 to 90 crores.
Okay. Vinny, just one final question. What is the kind of capex that you're looking at? Is there anything expected soon?
The capex plan for the year is about 300 odd crores. However, with freight rates coming off, we were hoping that the ship rates will also come back faster. That has not happened. So we are struggling to acquire a new ship. Okay. We're hoping that Q4 we will be able to do so. Barring that, the capex should be between around 150 crores.
All right, take that point. Wish you good luck, Vineet. You've done well in the past, but in the recent past, we've seen some weakness in the stock price. Let's see where that goes from here. 300 crore capex if they buy a ship, 150 crores if they don't. The stock currently at the low point of trade, primarily on account of weakness in the margins, which the company believes that will normalize once things recover in the shipping business. 3 of their ships were in dry docks in the previous quarter. With that, we'll slip into a short break, come back, get you more on the market. Welcome back. A bunch of stocks doing extremely well from the front line, and which is supporting the Nifty at levels upwards of 17,950. We have a few of them. Reliance, the biggest weight on the index, had done well on Friday, was doing well all of last week, and currently now has moved to the high point of trade. The other one we're looking at is HDFC Bank. That, of course, is the biggest weight on the Nifty Bank. Despite the underperformance on the Nifty Bank, HDFC Bank is the one which is actually outperforming, currently at the high point of trade. This is HDFC Limited. HDFC Bank is the other one which is up 2 odd %. The other couple of stocks which are up 2% each are both Bharti Airtel as well as L&T. Both of them report their numbers today. Also, fair weights on the index. That keeps the Nifty up by almost 1%. But the other stock, which is an unusual mover in today's trading session, and I call it unusual primarily because over the last few trading sessions, we've seen a sharp drubbing, but today it's made a bit of a comeback, and that's Nykaa. There are a couple of reasons for that. The first reason is that the company has gone ahead and shifted the record date for bonus issue from November 3rd to November 11th. What does this mean? That, the company was going to go 1:5x bonus, and as a result of which, the shares would optically look lower by about 20%. And a lot of people, benefit from that by selling the shares that they got into bonus, a phenomenon that's known as bonus stripping. It increases the supply on the counter. However, at a time where the company is already expecting some supply on the counter as the lock-in for pre-IPO shares opening on November 8 and 9, they've decided perhaps to, postpone it once all of this supply gets exhausted. Tomorrow, we have the second quarter results as well. So that is something we will monitor. But remember, this month itself, the stock is down 19%, 51% in 2022 so far. From highs, it's down 60%. So it's not been a good performer. So maybe at lower levels, some sort of bottom fishing might be taking place here as well.
All right, Mangalam, thanks a lot for getting us all of the details on Nykaa. But with that, let's move on and bring you a technical check on the market. Gaurav Ratnaparkhi of Sharekhan joins us for exactly that. Gaurav, good morning and thanks for joining us. It is a good-looking screen, whichever way you look at it. We're over 1% higher on the Nifty. We've, sustained after that gap-up opening. So would you take a call on the index level?
Yeah, good morning. So basically, what we are seeing in the Nifty is a range shift on the higher side. Till last week, 17,800, which is a 78.6% retracement of the entire September decline, that was acting as a resistance, and that had kept a cap on the higher side for the last week. But now today, with a gap up opening, Nifty has surpassed that hurdle. Nevertheless, 18,100 is the next barrier to watch out for. And we are expecting fresh round of selling to emerge from that zone of 18,100. So limited upside potential is there in Nifty from current level. We are not expecting any runaway rally, but this is just a pullback to retest that barrier. So avoid aggressive long position at this point of time, especially for the index specific trade. And one of the major contributing sector in terms of weightage, that is banking and financial services, is looking weak. If you look at Bank Nifty daily chart, then it has faced resistance near upper end of a rising channel in the last week. It formed a distribution over there at around 41,500 and has started sliding down. So 41,500 will continue to act as a resistance for Bank Nifty on the higher side. And unless that gets taken out, Bank Nifty can very well slip below 41,000 mark and head towards 40,800, 40,700 in the next few sessions. So as I mentioned, avoid aggressive long position in index specific trades.
Right, aggressive long positions should be avoided as we are closing in on resistance zones for both the Nifty as well as the Nifty Bank. Take your point, Gaurav. Individual stocks, what should one do? I mean, is there scope for any long positions there, or you're going short there as well?
Yeah, definitely. There can be stock-specific action in the market, and that's the reason I have picked up one on the long side and one on the short side. On the long side, I have picked up Trent. Basically, this stock was stuck in a consolidation range for last several weeks, and today we are seeing that consolidation breakout with a falling trend line breakout on the higher side. And the price breakout is being accompanied by strong volumes, which suggests that the prices are likely to sustain at higher levels. Even the daily Bollinger Bands have started expansion. So I'm expecting today's positive momentum to continue in the coming sessions. So one can buy the stock even at current level, although the stock is up by about 4% odd. Still, one can initiate fresh long position at current level, keeping a stop loss of 1480. And on the higher side, 1575 and 1620 will be the short-term targets to watch out for. And on the short side, as I mentioned, banking and financial services space is looking weak. So I've picked up one from that space, that is LIC Housing Finance. This stock had faced resistance near 78.6% retracement of the September decline in the last week. Over there, it had formed a shooting star, which is a bearish candlestick pattern in the last session. And today it is witnessing follow-through selling. And with that, the stock has broken its crucial daily moving averages as well as a rising trend line. So I'm expecting further selling pressure in the coming sessions. So LIC Housing Finance futures can be sold at current level with stop loss at 416. And on the downside, 390 and 380 will be the targets to watch out for.
All right, so Trent and LIC Housing are your two picks. So Gaurav, thanks a lot for joining us with that quick technical check on the market. With that, it's time for another short break on the show. But when we come back, we should focus and discuss the market fundamentals. This joins us now for exactly that. Siddharth, good morning and thank you for joining us. This is Pavitra, and I'm going to dive directly into the stocks because, some of them are moving really well. We have something like a Maruti, which is one of the top gainers. It's up over 2% today after that solid showing for the second quarter. A lot of the brokerages were also, up to their target price on this. So you take us through how you are looking at the stock. The company has a slew of new launches as well lined up. Do you think there's room for significant upside here?
Yeah, very good morning, Pavitra. So, company came out with strong results. We saw the revenue, although it is not comparable on a Y-on-Y basis because of the COVID-related issues last year. But still, if you look at the growth, it was pretty strong across revenue, EBITDA, PAT, both on a Y-on-Y as well as on a Q-on-Q basis. Volume growth was significant. If you look at it grew 36% on a Y-on-Y basis, even 11% on a sequential basis. And obviously, the start of the festive season did help them. What also helped them was the favorable commodity prices. Currency was favorable for them, and they also took price hikes. So all those things came favorable for them. The key factor was that the company is gaining traction in some of the newer launches. They were missing, there was a big gap in the mid-size SUVs that they had not been present for a very long time. They were present in the entry-level SUVs, but that now gap got filled with the launch of the new Vitara and the Grand, the new Grand Vitara and the Brezza. So that kind of fills the gap in the mid-size SUV segment, and it's gaining a lot of traction there. Also, another factor was that the semiconductor availability has been easing across the auto sector, be it Maruti, be it for two-wheelers, be it for M&M. So that is a positive point for the entire auto sector. So I think Maruti is our preferred pick within the auto space, given its presence and market leadership in the passenger vehicle segment, where we see the threat of EVs being lesser compared to two-wheelers, where the penetration of EVs is seen much faster, and the impact on the incumbents, which are very late entrant into the EV space. So I think that is something which will help Maruti drive about 20% revenue CAGR over the next 2-3 years. Hence, we like that as our preferred pick within the auto space.
Take that point, Siddharth. You know, I'm just looking at a couple of these stocks. You've been positive on the business model of Nykaa in the past as against some of the other platform companies, and that stock, as we speak, is up almost 6.5%. They've shifted their record date for bonus by about 7-8 days. In the interim, we will have that supply coming in with the pre-IPO anchors or rather shareholders opening up as well for supply. What are your thoughts on Nykaa now? Do you think it's a good time for those who did not get it in the IPO, or maybe wait?
So, Mangalam, I think although we don't have an official coverage on Nykaa, I've been personally seeing this, preferring this business over some of the other new age digital platforms, given the niche business model that they are present in, where we see consistent growth for the beauty and the personal care segment. Be the business model of the omni business channel model that they have adopted of online as well as offline store, and plus they have already shown profitability. But if you look at what has happened to the platform companies in terms of share price across, is that there was huge demand post listing, but with the sharp fall in the US tech companies, these stocks have also seen a beating, with some of these large FIs exiting the stock. And that's the fear now with some of the large PE investors which had invested pre-IPO. They could exit once the lock-in gets over, because even at these prices, they would be making huge profits. I think once the dust settles down with the sell-off happening for the pre-IPO investors, I think the stock should find some support. There is some rationale for the core business, which does well, and they're showing good growth. So we are positive on the overall consumer discretionary space. This festive season has been positive across segments, be it a Titan, be it some of the auto players. I think Nykaa should do well, but someone needs to have patience to buy some of these new age businesses and have that kind of holding period to see through the interim volatility and come on the other side of this volatility.
All right, that is on Nykaa. Siddharth, any of the other new age businesses? Do you like any of the others?
No, so I think we don't have a lot of coverage on this space as of now. These are a bit difficult to look at, especially for traditional analysts like us. But I think some of them will do well because the growth potential is huge. I just need to see which one picks up and which one survives among them. That's the question one needs to see.
Right. You know, you spoke about the auto space, you spoke about Maruti. I remember you being positive on some of the auto ancillaries as well. Motherson, for instance. Now, how do you, view that company, given that the domestic business is doing well, the company is split into two, but the European vertical may be facing some problems because of the weakness that we're seeing in Europe?
So, Motherson, I think clearly the domestic business, which almost 95% comes from the India wiring harness business, and is clearly positioned to benefit from the EV growth in India, benefits out of the current growth. We among the two, we like Motherson Sumi Wiring because of its inherent strengths, given the global volatility and the business model, which is kind of future oriented. Now, Motherson, the Samvardhan Motherson, which is largely focusing on the European business, will see pressure in the near term because of what is happening in Europe. The business model is sound, is good, but definitely one needs to wait for the European crisis that is currently going on to get over, and we don't know when that will happen and how that will happen. So I think one needs to wait for Samvardhan, but I think clearly we prefer Motherson Wiring.
All right, got that. Siddharth, another space that you like, which, pretty much everyone we speak to likes, is the banking and financial services space. What do you like within this space? If you could pick out some names for us.
Yeah, Pavitra, so we have been positive on ICICI, SBI. That has been our preferred picks within the overall banking space for quite some time. But incrementally, we are seeing that the credit cycle in India is picking up. The system credit growth is now almost multi-year high. And with that, a lot of other banks have started reporting strong numbers. So incrementally from here, we like something like an IndusInd Bank, which has now started doing well. We see sharp recovery in its core vehicle finance as well as microfinance business. That is something we like. Among other smaller banks, we like Federal Bank, again, another smaller bank, which has now started reporting strong numbers. We see some of these banks now benefiting because of the overall credit growth that the system is witnessing. We are seeing that companies, the public capex, the government capex had been very strong, but after a very long period now, the corporate or the private capex cycle is picking up. We are hearing a lot of companies talking about or already started doing capacity expansion to meet the future growth, and that is something that will not only benefit the capital goods sector, but will in a large way have a positive rub-off on the banking and financial segment as well.
All right, take that point. Always a pleasure speaking with you. Wish you happy festivities, Siddharth. Thank you for joining in. With that, we'll step into a short break. But as we do that, here's some great news for you investors. You can track the US markets now in real time on moneycontrol.com. And L&T is the stock we'll be talking about. In fact, we'll be hearing from the management after it reports its numbers just after market close today. Vivek is standing by with all that the street is expecting with regards to this capex major. Vivek.
Well, absolutely right. We are talking about L&T earnings today. Markets are keenly anticipating these numbers. So much, hinges on the commentary of the management post the results as well. Talking about the numbers, revenues are seen closer to 38,500 crore mark, up almost 10% on a year-on-year basis. EBITDA is seen higher by 9%. Remember, EBITDA as well as EBITDA margins are expected to be aided by the fact that the export duties that came as far as steel has cooled off prices of most of the commodities, and this is something that is expected to aid the margins. While L&T does have a cost pass-through as far as most of its contracts are concerned, some of the contracts that it has does not have this cost pass-through, which is why in the quarters gone by, the company did face the brunt of margin pressures due to surging commodity prices. Profitability is seen higher by close to 20% on a year-on-year basis. Now, some of the key highlights, a very strong order backlog, the softer commodity environment, which I alluded to earlier, and also given the fact that the company has already announced orders worth almost 14,200 crores in the quarter gone by. Also, when you're talking about what JP Morgan is expecting from these numbers, JP Morgan says that, L&T is up for a very strong quarter on ENC-led profitability. BofA Securities says that, it's very important quarter for L&T. Remember, the subsidiaries of L&T, the three subsidiaries, Mindtree, LT, TS as well as LTI, have all derated significantly in terms of valuation, while the core valuation of L&T has risen. So, it's important for the company to deliver a good quarter for these valuations to sustain.
All right, Vivek, thanks a lot for getting us all of those expectations from L&T. The other big earnings, of course, from Tata Steel as well as Bharti Airtel, so we'll watch out for those as well, and you keep them on your radar. But with that, we're going to wind down. The market is in fine fettle, over 1% higher. Thanks a lot for tuning in. Halftime Report is up next.